What's up guys, it's Antoine here, and in this video I'm going to show you how you can use debt to get rich, potentially very rich. So there are many different kinds of debt out there, and there are people like Dave Ramsey who talk about not getting debt at all and never using debt, but I beg to differ. So many people talk about debt like it's a bad thing, how they don't want to be in debt, they don't want to owe anybody, they don't want to owe a bank or anything like that. But what if I told you that debt could be good? The most wealthy people in America use debt to their advantage, and they use debt to get ahead of everybody else. It's how the rich get really rich. So for the last 12 months, I've used over $20 million worth of debt to buy 200 plus single family homes and make millions of dollars of profits doing it. So in this video, I'm here to teach you guys how I use debt on a daily basis for all of my different businesses and how you should too. But before we get into all that, please make sure to like and subscribe so you guys can be notified when I post new content about different strategies and different ways that me and my team are currently using to invest in real estate across the country. First, you have to understand the difference between good debt and bad debt. And in order to understand that, you have to understand the difference between an asset and a liability. So an asset is something that you buy that makes you money every single month. And basically a liability is something that you buy that you have to pay for every single month. So good debt is when you use that debt to buy assets. And bad debt is when you use that debt to buy liabilities. One of the common misconceptions is that people think that buying a single family home to live in is an asset. However, buying a house to live in is a liability. And it's a liability because you're living in that property and you're paying money every single month. Buying a house to live in is not making you money, not making you an income every single month, like a rental property would. So if you're buying a single family house to live in, even though that property may appreciate over time, that is still not an asset, that is a liability. That would make buying a house that you live in bad debt. So buying an asset for good debt or buying something for good debt would be buying a rental property, for example. If you buy a rental property for $150,000 and you get a loan for $100,000 and you rent out that property for $1,500 a month, that is now good debt because that is an asset. So long as that rental property still cash flows, that is going to be an asset. Some common liabilities that people buy all the time with bad debt would be things like cars. But you can easily make a car an asset by renting it out. There's plenty of apps online where you can take your car, for example, and lease it out on Turo and turn that liability and that bad debt into good debt and turn it into an asset. So when people tell you to never get a credit card and never get a loan, those people are completely wrong. For certain kinds of people like shopaholics who cannot stop spending money, I would definitely recommend shredding your credit cards and doing different things like that. That is the bad debt you have to avoid. If you start using good debt to buy businesses, stocks, and real estate, that's good debt that pays itself off over time. So for example, if you have a property that you bought with debt at 4.5% interest, but it's making you an 8% return on your money, that's a 3.5% return in your pocket. And that's why real estate is the best kind of good debt. Right now, the difference between you and multimillionaires is that they use their good debt with real estate to create wealth. And Andrew Carnegie said that 90% of millionaires become so through owning real estate. Now that we've established that good debt builds wealth, here's why real estate is the best kind of good debt. So let's say you have a house for $100,000, you don't have to come up with $100,000 to buy that product. But if you want to buy $100,000 worth of Google stock, you have to come up with $100,000 out of your pocket. The benefit of real estate is that to buy a $100,000 house, you only need $20,000 out of your pocket. So with that same $100,000 that you were going to put into the stock market, you can now buy $500,000 worth of real estate that will eventually be paid off in the next 30 years. One of the other benefits of real estate over stock market is that real estate pays you every single month in terms of cash flow. Every single month, tenants pay their rent, which covers your expenses, and you get net proceeds every single month. The last best reason is that other people pay off your debt for you. Rents occasionally fluctuate, but they really only go one direction, which is up. Rents are up by 11.5% in 2021 and are poised to go even higher over the next few years. So the other benefit to getting good debt on real estate is that no matter what happens to the market, you can still cash flow positively. So let's say you bought a house for $100,000 and that house a year after you bought it is only worth $50,000. Rents are not going to be cut in half and your debt is going to be still very stable. So long as you can pay your debt, you still will be cash flow positive no matter what the house is worth. This is great because real estate is a hedge against inflation and also a market crash. And the other great thing about real estate is that you have 30-year fixed interest rates. And what that means is that over the entire life of the loan, nothing will ever change. The interest rate will never go up. You'll be locked in for the same monthly payment for the next 30 years until that loan has been fully paid off. Another way that people use good debt is by buying real estate and then refinancing those properties in a couple of years when those homes have appreciated. People are then able to take out money tax-free and use that money to take on more good debt to buy more assets. So what a refinance means is, let's say you bought a house in 2018 for $100,000 and that home today is worth $200,000. Let's say when you bought that house, you had a loan for $80,000, but now the home is worth $200,000, so you have $120,000 worth of equity in that home. So what you can actually do is go back to the same lender and say, hey lender, you gave me a loan for 80,000 bucks. The home is now worth $200,000. I'd like to get another loan on the property. I'd like to refinance. So you'll go to that lender, they'll do an appraisal for $200,000 and give you a brand new loan. They'll pay that loan off for $80,000 and give you a new loan for $160,000 if that property does appraise. So now the difference between the old loan and the new loan, which is $90,000, you'll be able to write a check to yourself and go buy more houses with it. And the difference between the old loan and the new loan will be a check to you directly, tax-free. It'll be cash in your pocket that you'll be able to use to go buy more real estate with more good debt. And it's tax-free because you're not selling anything, you're taking on more debt. So the government doesn't see that as a taxable event. So the beautiful thing about this is as you continue to grow your real estate portfolio, every 3 to 5 years, you'll be able to refinance and pull out more and more cash. You can then use that capital to continue to grow your real estate portfolio for years to come. And every 3 to 5 years, you'll be able to pull out more and more capital to continue the process. The other benefit of all these income producing assets, all these rental properties, is that now these are all going to go on your tax return as income. So all this additional income for your real estate portfolio, all this cash flow will go on your tax return to help you qualify for better debt. So with that, you'll be able to take on even more debt and buy even more properties. So essentially that means the more rental properties you have, the more income you make every single month, the more debt the banks will give you. The key to all of this is great property management. So when you're buying some rentals and it could show even 50 or 20% returns on paper, without a good team on the ground, none of this can be realized. The key to having stable long-term profits over time is having a fantastic team on the ground, and that all starts with property management when you're dealing with rental properties. The ultra wealthy, even though they may have billions of dollars in their bank account, still use good debt every single day. So we've talked about good debt, about how you and I can both use good debt to buy rental properties. But now I want to talk about how the ultra wealthy also leverage debt and use debt on a daily basis. Warren Buffett and other billionaires across the world still use debt. No matter how much money they have in their bank, they still use low interest debt to buy real estate, businesses, and other things. The reason why they do this is because it allows them to split up their risk and also take on other people's money to fund deals that they're a part of. So let's say you're Warren Buffett and you have $100 million in your bank account. You can use that $100 million to buy $1 billion worth of real estate. Instead of taking your $100 million and just buying cash, $100 million worth of real estate. With $1 billion worth of real estate, your portfolio will also be much more stable and you'll provide a higher return. And even after everything that we've talked about, debt is great for one more thing: taxes. The more debt you have, the more that you can write off, which means the less that you pay in taxes. When our clients buy turnkey rental properties from us, we recommend them go and get debt. The reason why is because these turnkey rentals make $200 to $300 a month in net cash flow. They're able to write off the interest expenses every single month from the loan that they took out, essentially making this $200 to $300 a month tax-free. Another thing that's great about buying real estate and using good debt to buy cash flowing assets is something called cost segregation. Now, I won't get into it too much in this video. I'll make some future videos about it. But essentially, you can go and buy a property for $1 million, get debt for $800,000 on that property, put $200,000 down, and save $400,000 to $500,000 in taxes. So essentially what a cost segregation study is, it's relatively inexpensive, but it can save you a ton of money on taxes. It costs anywhere from $5,000 to $10,000 if you're doing a large building. Essentially what the study does, it takes a building and it breaks it down into many different components. Because for example, kitchen appliances or HVAC units or hot water tanks are depreciated at 7 years versus 28.5 years. So essentially what the study does, it breaks down the property into many different components and allows you to write them all off over 30 years, which means that the year that you buy that property, you're able to lower your taxable income even further. So the benefit of the cost segregation study is that you're able to spend $5,000 to $10,000 to complete the study, which breaks down a building into many different parts and depreciates them over different time periods. The net effect of this is that it can save you money over time on your taxes. So like we talked about earlier, a lot of real estate investors use cash out refinances to continue adding debt to their properties to keep lessening their tax burden. But with those cash out refinances, real estate investors are able to take out huge lump sums of money and use that money to further invest, and all of that cash that they're getting from their cash out refinances is completely tax-free. And the reason why a cash out refinance is not a taxable event is because the SEC said it's not. And this leads us to our last and most important point: over leveraging. So even though you may be buying cash flowing rental properties and buying assets all day long with a good debt, there is a point where you could be over leveraged and put yourself in a very high risk situation. So one of the reasons for the 2008 real estate crash was that people started over leveraging. Banks and lenders got very greedy and started lending out funds at 90 to 100% loan to value. So that means that you can go and buy $1 million apartment building, put $100,000 down and get debt for the rest. This becomes an issue because the real estate investors didn't have any skin in the game. It cost them very little amounts of money to get into real estate deals, and they didn't care what went wrong. So make sure that you don't make the same mistake. Since 2008, the government has regulated a lot more on lending and lending guidelines, and most lenders will not lend over 80% loan to values right now. So I would personally recommend getting loans on rental properties and getting loans on assets. Anything from 70 to 80% is a good range. Even if you're doing cash out refinances or buying new properties, so long as you keep the loan to value below 80%, you'll be in good shape. Some other things to worry about are HELOCs and other lines of credit. The problem is if you pull some money from this HELOC or other lines of credits and use it to buy assets, the HELOC company can call on those notes and order them due. This may happen if there's a market crash or the interest rates go through the roof. Let's say the lender lent you money on a HELOC at 4%, but now the interest rates are at 8%, the company might call you. So a couple of things to think about when you're taking out loans: make sure that the lenders not have a call option where they can just pull the note at any given time. And also make sure on the loans that you're getting that they're not adjustable rate mortgages. With all this in mind, I believe that the best way to get rich by using good debt is to buy cash flowing real estate. Interest rates are at record lows, the lowest rates that we have seen in over 4,000 years. So I would encourage everybody listening to take advantage of the record low interest rates and go buy cash flowing rental properties across the country. Contrary to public belief, you don't need much money to get started in real estate investing. If you have $20,000 to $30,000, you can start buying cash flowing turnkey rental properties across the country. I use debt for many different things. I use debt to flip houses, to buy rental properties, to buy apartment buildings, to flip apartment buildings. Pretty much everything that I do real estate related involves debt or other people's money. I would highly recommend that you go raise other people's money or use debt to invest in your real estate projects and other businesses. Here are some examples of strategies that you may be able to implement. If you have rental properties and you have equity, I would highly recommend going and getting a refinance on that, pulling the money out and using that cash to buy more rental properties. If you own a personal residence and you have a ton of equity in your personal residence, I would also recommend pulling out a refinance, using that money to go and buy investment properties and buy real estate across the country. If you're refinancing a personal residence, you should try to get an interest rate below 4%. If you're doing a refinance on an investment property, you should try to keep your interest rate below 5%. And if you have some cash in the bank and you're looking to buy your first real estate investment property, you can go to martelturnkey.com and we'll connect you with a lender. If you have a ton of money in the stock market or in the crypto space, I would also highly recommend you pull some money out of that and start buying some cash flowing rental properties. You want to take advantage of these record low interest rates before they begin to go up. So I know this is a complicated topic, but leave your comments below and I'd love to answer them for you. Hit the like and subscribe button down below so you can see my tips and tricks to create wealth through real estate by using debt. Thank you and see you on the next one.